Ladies and gentlemen, there is a number sitting on the Federal Reserve's balance sheet right now that almost nobody watching this video has looked at closely. And once you understand what it means, you will never look at your gold holdings the same way again. This isn't about fear. It isn't about hype. It's about a pattern that has repeated itself at least 4 times in the last 100 years. And every single time, the people who understood it early protected their wealth, while the people who didn't watch it evaporate in real time. So stay with me for the next few minutes, because by the end of this video, you're going to understand something about gold, about currency, and about how governments quietly manage the value of money that most financial commentary simply never explains. Before we go further, I'd love to know where you're watching this from and whether you currently hold your savings in gold, in silver, or mostly in cash. Drop it in the comments below. It genuinely helps me understand who's watching, and I read every single one. Now let's build this properly from the ground up, because if I just tell you gold might struggle without explaining the machinery behind that statement, you'd have no way to judge whether I'm right or simply guessing. And guessing is exactly what most financial media does. So instead, let's think like an economist. Let's think about incentives, about historical precedent, and about the psychology of the people who move markets. Here's the first thing you need to understand. Gold has never really competed with stocks or real estate or bonds in the way most people assume. Gold competes with currency itself. It is in the truest sense a referendum on trust. When people trust the institutions managing their money, the central bank, the treasury, the government's fiscal discipline, they don't feel a strong need to hold gold. It just sits there, a quiet insurance policy nobody bothers to think about. But when trust erodes, when people start to suspect that the money in their bank account is being quietly diluted, gold suddenly becomes very interesting again. This is why gold prices don't move in a straight line with inflation or with interest rates or with any single variable. Gold moves with confidence, or more precisely with the lack of it. To understand where we are today, we have to go back and look at how modern monetary systems actually work, because most people were never taught this, and it's not their fault. It simply isn't part of a standard education. After the world abandoned the gold standard in stages throughout the 20th century, culminating in the final break in 1971, currencies became what economists call fiat money. That means the dollar, the euro, the yen, none of them are backed by a physical asset anymore. Their value rests entirely on confidence in the government and central bank that issues them. This gave central banks enormous flexibility. They could expand or contract the money supply, adjust interest rates, and respond to crises in ways that would have been impossible under a gold-backed system. But that flexibility comes with a cost, and the cost is discipline. Without gold anchoring the system, the temptation to solve problems by printing more money becomes almost irresistible, especially for governments carrying large amounts of debt. And this is where the story gets interesting, because right now in 2026, the United States is carrying a level of national debt that would have been unthinkable a generation ago. When debt grows faster than the economy that has to service it, governments generally have a limited number of options. They can raise taxes, which is politically painful and slow. They can cut spending, which is even more painful and slower still. They can default, which is almost never chosen by a country that because it controls its own currency, because it's simply unnecessary. Or, and this is the option history shows governments reach for, again and again, they can quietly reduce the real value of the debt by allowing a snort's higher rate of inflation than official targets suggest, effectively paying back their obligations with dollars that are worth less than the dollars they originally borrowed. Economists have a name for this. It's called financial repression, and it isn't a conspiracy theory. It's a well-dominant policy approach that governments have used openly throughout history. Keeping interest rates below the rate of inflation for an extended period is one of the most effective ways to erode the real burden of government debt, because savers and bondholders end up subsidizing the government without ever seeing a specific bill for it. It happens gradually through the quiet math of compounding inflation, and by the time most people notice, a meaningful portion of their purchasing power is already gone. Now, here's where politics enters the picture. And I want to be very careful and precise here, because I'm not going to tell you there's a secret plan, because that would be dishonest. And dishonesty is exactly what I'm trying to help you avoid falling for elsewhere. What I will tell you is this. There is a well-documented, publicly stated preference shared across administrations of different parties over the decades for lower interest rates and a weaker dollar, because both of those things make it easier to service debt, easier to boost exports, and easier to keep asset prices rising in the short term. This isn't unique to any single president. Every administration wants cheaper borrowing costs. Every administration benefits politically from a booming stock market and rising home prices. And every administration faces pressure to lean on the Federal Reserve, even though the Fed is supposed to be independent, precisely because monetary policy has such enormous influence on how prosperous people feel in the short run. So when you hear discussions about pressuring the Federal Reserve to cut rates faster, about preferring a weaker dollar to help exporters, about wanting looser financial conditions heading into an economic cycle, understand that these are not secrets. They are openly discussed policy preferences consistent with decades of political incentives, regardless of who occupies the White House. The question worth asking isn't, is there a secret plan? But rather, what happens to gold specifically if these openly stated preferences actually get implemented? And this is where it gets genuinely fascinating, because the answer isn't as simple as most people assume. There's a common assumption that loose monetary policy is automatically good for gold, and historically that's often been true, but it's not the whole story. Gold responds most powerfully not simply to loose policy, but to loose policy combined with declining confidence in the institutions managing that policy. If the Federal Reserve cuts rates in a controlled, credible way in response to genuinely slowing growth, markets tend to treat that as reassuring, and gold's reaction can actually be muted. But if rate cuts appear driven by political pressure rather than economic necessity, if markets begin to suspect the Fed's independence is being compromised, that's historically been one of the most powerful catalysts for gold rallies, because it signals exactly the kind of institutional erosion that gold has protected against for thousands of years. This brings us to a crucial historical parallel, and I want to walk through it carefully because history doesn't repeat exactly, but it rhymes in ways that are instructive. In the 1970s, the United States faced a combination of high inflation, political pressure on the Federal Reserve, and a series of external shocks, including the oil crisis. Arthur Burns, who chaired the Fed during much of that period, faced significant political pressure to keep policy loose heading into elections, and many economists now view that period as a case study in what happens when monetary policy loses its independence from short-term political incentives. Inflation became entrenched, eroding the purchasing power of savers for the better part of a decade. Gold, which had only recently been allowed to trade freely after the end of the gold standard, rose from around $35 an ounce to over $800 an ounce by 19, an extraordinary move that reflected not just inflation itself, but a genuine crisis of confidence in the dollar and in the institutions managing it. It wasn't until Paul Volcker took over the Fed and aggressively raised interest rates, even at the cost of a painful recession, that inflation was finally broken and confidence gradually restored. That episode taught an entire generation of economists a lesson that is echoed through every subsequent debate about central bank independence. Short-term political comfort and long-term monetary stability are often in direct tension, and when politics wins that tension, the ultimate cost is paid by savers, by currency holders, and by anyone who assumed their money would hold its value. Now, I'm not telling you that 2026 is a perfect replica of the structural conditions are different. Globalization has changed how inflation transmits through economies, and central bank communication is far more sophisticated today than it was 50 years ago. But the underlying tension between the political desire for loose money and the economic necessity of disciplined money, that tension is timeless. And it's precisely the tension that determines gold's medium-term trajectory more than almost any other single factor. Let's talk about central bank buying, because this is a piece of the puzzle that most retail investors have completely overlooked, and it's arguably more important than anything happening in Washington. Over the past several years, central banks around the world, particularly in China, India, Russia, Turkey, and several other emerging economies, have been buying gold at a pace not seen in decades. This isn't speculative buying. Central banks aren't trying to time a trade. They're making a strategic multi-depth decision about how to structure their reserves, and the reasoning behind it tells you almost everything you need to know about where global confidence in the dollar-based financial system currently stands. After the United States and its allies froze a significant portion of Russia's foreign currency reserves following the invasion of Ukraine in 2022, something changed in the calculus of central bankers around the world. It became clear that holding reserves in dollars or in dollar-denominated assets carries a risk that many countries had never fully priced in before, the risk that those reserves could be frozen or restricted based on geopolitical decisions entirely outside their control. Gold, by contrast, sits in a vault, physically held, immune to sanctions, immune to a foreign government's freeze order. For For a central bank thinking in terms of decades and worried about geopolitical fragmentation, that's an extremely attractive property, even if gold pays no interest and sits idle in a vault. This is why central bank gold buying has remained remarkably resilient, even as prices have risen substantially. This isn't the behavior of short-term speculators looking for a quick profit. It's the behavior of institutions making a long-term strategic bet on diversification away from a purely dollar-centric reserve system. And when you understand this, you start to see gold not simply as a commodity that goes up and down with sentiment, but as a genuine barometer of how much the world's largest financial institutions trust the current architecture of global finance. Now, let's bring this back to the psychology of the individual investor, because understanding the macroeconomics is only half the picture. The other half is understanding your own brain, and I mean that literally at the level of biology. When markets become volatile, when headlines scream about currency risk or inflation or geopolitical conflict, your amygdala, the small almond-shaped structure deep in your brain responsible for processing fear, becomes highly active. This isn't a metaphor. Researchers studying investor behavior have found that financial losses activate many of the same neural pathways as physical pain. Your brain quite literally processes the fear of losing money using ancient survival circuitry that evolved to keep your ancestors alive when facing predators, not when facing a fluctuating asset allocation. This matters enormously for how people actually behave with their money, because it means that in moments of genuine uncertainty, the decisions most people make are not calm, rational calculations. They are fear-driven reactions executed by a brain that's essentially treating a market downturn the same way it would treat an actual physical threat. This is why so many investors buy at the top when euphoria triggers dopamine-driven greed and sell at the bottom when fear triggers a cortisol-driven flight response. Understanding this isn't just interesting trivia. It's arguably the single most important piece of investing knowledge that has nothing to do with economics and everything to do with why smart, capable people consistently make poor financial decisions at exactly the wrong moments. Let me tell you about someone I'll call David, a 52-year-old small business owner from Ohio. This is a fictional story, but it reflects a pattern I've seen described countless times in real investor behavior studies. David had spent 15 years slowly building a diversified portfolio, and in early 2020, when markets crashed at the onset of the pandemic, he watched his portfolio drop nearly 30% in a matter of weeks. His amygdala quite understandably screamed at him to get out to protect what remained. He sold a significant portion of his equity holdings near the bottom, converting the loss from a paper loss into a permanent realized one. Over the following 2 years, as markets recovered and then surged to new highs, David sat mostly in cash, watching the recovery from the sidelines, paralyzed by the fear of another crash that never came in the way he expected. His story isn't a story about bad luck. It's a story about biology overriding strategy, about a brain doing exactly what it evolved to do in a context where that instinct actively worked against him. Now contrast that with a story I'll call Priya's. For 34-year-old software engineer, also fictional but illustrative of a very different, well-documented pattern, Priya began allocating a modest, consistent percentage of her savings into physical gold, starting in not because she was trying to time any particular crisis, but because she'd read enough economic history to understand that gold functions as a form of insurance against currency debasement and systemic shocks. She didn't dramatically increase her allocation during periods of panic, and she didn't dramatically decrease it during periods of euphoria. She simply treated it as a structural piece of her portfolio, rebalancing modestly once a year. By the time gold experienced significant rallies during periods of monetary uncertainty in the years that followed, her disciplined, unemotional approach meant she captured much of the upside without ever having made a single high-stress, high-stakes decision. Her outcome wasn't the product of brilliant market timing, it was the product of removing emotion from the equation almost entirely. And one more, a story I'll call Marcus, 67 years old, recently retired. Again, fictional, but reflecting a genuinely common and important lesson. Marcus had done almost everything right throughout his working life, saving diligently and investing steadily. But heading into retirement, he made a decision common among people his age to move almost his entire portfolio into cash and short-term bonds, believing this represented the safe choice. What he hadn't fully accounted for was inflation risk. Over the following several years, even modest inflation quietly eroded the purchasing power of his cash holdings, meaning that while his account balance looked stable on paper, what that balance could actually buy declined meaningfully. Marcus' story illustrates something crucial that too many investors miss. Cash feels safe because it doesn't fluctuate in nominal terms, but it carries its own very real risk, The risk of slow, quiet erosion that doesn't show up as a dramatic headline compounds just as relentlessly as any market crash. These three stories illustrate the same underlying truth from three different angles. The risk in investing isn't only about volatility, it's about the mismatch between how our brains are wired to respond to short-term fear and greed and what long-term financial preservation actually requires. Before we continue into the second half of this video, where I'm going to walk you through the specific mechanics connecting Federal Reserve policy, bond markets, and gold's likely path forward, I want to ask you for two small things. If you're finding this kind of grounded, evidence-based economic analysis valuable, consider liking this video. It genuinely helps this kind of long-form content reach more people who are tired of clickbait and fear-mongering. And if you haven't already, consider subscribing, because I'm going to be covering these macroeconomic shifts in detail as they unfold. I'd also strongly encourage you to stay until the very end of this video, because the final insight I want to leave you with only makes sense once you understand everything we're about to walk through. And I think it's genuinely one of the most important frameworks for thinking about your money that you'll come across this year. Now, let's talk about bond markets, because this is the piece of the puzzle that connects everything we've discussed so far, and it's frequently misunderstood even by relatively sophisticated investors. When a government runs a large deficit, it needs to sell bonds to finance that deficit. The buyers of those bonds, whether they're pension funds, foreign governments, or individual investors, are essentially lending money to the government in exchange for a promise of repayment with interest. As the supply of new bonds increases, and if demand doesn't increase proportionally, bond prices face downward pressure, and yields, which move inversely to price, tend to rise. Rising yields increase the government's borrowing costs, which increases the deficit further, creating a feedback loop that becomes increasingly difficult to manage without intervention. This is where the Federal Reserve's role becomes critical and controversial. One of the tools available to a central bank facing this kind of dynamic is to step in and buy government bonds directly, a practice often referred to as quantitative easing, or more informally as a form of debt monetization. This increases demand for bonds, which helps keep yields lower than they would otherwise be, but it also expands the money supply because the central bank is essentially creating new currency to make these purchases. In the short run, this can stabilize bond markets and keep borrowing costs manageable. In the medium to long run, if done at a large enough scale, it risks debasing the value of the currency itself, because more currency is chasing the same amount of goods, services, and assets in the economy. This is precisely the mechanism through which loose monetary policy, financial repression, and currency debasement connect directly to gold. Gold cannot be created by a central bank. Its supply grows slowly and predictably, constrained by the physical reality of mining new ounces out of the ground, typically increasing the global above-ground supply by only around 1% to 2% per year. This scarcity is precisely why gold has functioned as a store of value across virtually every civilization in recorded history, from ancient Egypt to the Roman Empire to modern central bank reserves. When currencies can be created at will and gold cannot, the relative value between the two shifts, particularly during periods when currency creation accelerates. Now, let's connect this to what's actually happening in 2026, being careful to describe only what is publicly known and documented rather than speculating about hidden intentions. The United States continues to run substantial fiscal deficits, a pattern that has persisted across multiple administrations regardless of party. The national debt continues to grow both in absolute terms and relative to the size of the economy. Interest payments on that debt now represent one of the largest and fastest growing line items in the federal budget, competing directly with spending on defense, healthcare, and other priorities. This creates genuine structural pressure toward the kind of policies we've discussed: lower rates, a managed dollar, and continued central bank flexibility, not because of any single administration's secret agenda, but because these pressures exist regardless of who holds political power. They are baked into the mathematics of the debt itself. At the same time, geopolitical fragmentation continues to reshape how countries think about reserve currencies and trade settlement. Trade tensions, sanctions regimes, and efforts by various blocs of countries to reduce their reliance on the dollar for international trade all represent forces that over time could gradually reduce global demand for dollar-denominated assets. I want to be careful here because there's a meaningful difference between de-dollarization is happening gradually at the margin, which is well documented, and the dollar is about to collapse, which is not supported by current evidence and would represent pure speculation. The dollar remains by a wide margin the dominant global reserve currency, and that's unlikely to change quickly, but gradual shifts at the margin sustained over years are exactly the kind of slow-moving trend that tends to matter enormously for an asset like gold, which responds to structural multi-year shifts in confidence rather than single dramatic events. So where does this leave gold specifically? And what could genuinely challenge it going forward?